Hi, welcome to Portland's second virtual webinar. For anyone that doesn't know me, my name's Nicola Layland. I'm one of the directors at Portland, and I'll be speaking to you for about the next 20 minutes on the financial implications for small businesses post-lockdown. So hopefully that is now visible to everybody. Perfect. So, as an insolvency practitioner, one thing that most people want to know is how busy we are. The general feeling at the moment is that there must be a huge number of insolvencies because of everything that's going on in the economy. And certainly, whilst we are not quiet, the insolvency market itself is actually considerably down on where you'd expect it to be this time in a normal year. And the feeling might be that that's a good thing. Less companies are failing, therefore it's actually positive. But in reality, it is concerning. The government support that's available simply can't last forever, and I think we all know that at some stage it's going to have to come to an end. And it's likely in the last 12 months that companies have been accruing debts. The amounts that have been deferred for HMRC, for example, amounts due to creditors haven't been paid, and there's concerns with regards to employees and how they're paid. With companies coming out of lockdown, they suddenly will go from having employees on furlough, not having to make any payments, to having to make 100% payments to them at a time potentially when there's not going to be a considerable amount of income coming in. And looking at those loans that were taken out, the bounce back loans, the CBILS loans, they're going to start to fall due. And when they were taken out, I don't think any business owner really thought we would be in this position now. Taking a loan out 12 months ago to bounce back over a short period of time to find themselves 12 months on just coming out of the lockdown. And with the government legislation in place, there's been protection for the tenants. So there's been rent holidays for some. There's been others where they haven't paid rent, but landlords have been unable to do anything in terms of enforcement. But rent holidays don't mean rent-free, and unfortunately for a lot of these companies, they're going to find that they've got rent they're going to need to start paying, and they've actually potentially extended the terms of their lease. So I'm going to speak about the options available, ranging from informal negotiations through to liquidation. So can informal negotiations work? Well, they're the cheapest and possibly easiest thing for a director of a company. They simply get in contact with their creditors, they agree with payment plan, and provided everybody's happy, then they're able to move on with their business. But this only works if all the creditors agree. If you've got one or two creditors that won't agree to that plan, it's going to be very difficult for those businesses to make payments to those that have agreed at the same time as having demands for full debts from those that haven't. And over time, I've seen many directors overpromise in terms of how much they can afford to pay. And I don't believe it's intentional. I think what they're trying to do is they're trying to give the best outcome possible to their creditors. They want to show that they can pay it quickly, and also they want to get themselves out of debt. So what they end up doing is over-promising and then unfortunately not being able to meet what they've promised, and having to go back to creditors a second time and ask for yet more time. And by that point, the creditors unfortunately start to lose patience. And with this, cash flow is going to be absolutely key. This is where these business owners, they need their accountants, they need their bookkeepers to help them produce a cash flow to show what they can actually realistically afford. And we go back to the landlord position. It's going to be difficult to actually get an informal negotiation with a large landlord. Whilst it might work if you've got a landlord that's an individual, someone that's got possibly one or two properties, that might work. But for the larger landlords, they're not going to be in a position where they can just accept an informal negotiation to potentially re-gear a lease or agree a lower term. And exiting a lease is really tough. So for some, they'll find that having come out of lockdown, they no longer need or want their premises. So how do they exit that premises at a time when they've not got funds available but they're suddenly going to have to make payments for dilapidations, for the balance of the lease. It's a really expensive thing to do when cash flow is really tight. And obviously that's going to vary from company to company. I know that our team are really keen to be back in the office. I know others are in a similar situation, but there'll be other businesses where they've decided actually that there is no point in having an office anymore. We're going to move to a virtual space. We're going to move to maybe serviced offices, but they've got these leases in place, and how do they exit them? So whilst informal negotiations can work, it's really going to be based on those companies that have potentially got sort of small levels of debt where they can just manage it themselves over a short period of time. So if we move on from those that aren't able to use the informal negotiations, then we move to something more formal, like a company voluntary arrangement. So could a CVA be useful for these companies? They can be used to pay debt over time. We all see those adverts that, you know, little known in government legislation that allows you to write off debt. In reality, a CVA can be whatever the agreement is between the company and its creditors. So it's a form of contract, for want of a better term. So the company works out, again, with its cash flows, having worked with its accountants, its bookkeepers, how much it can afford to pay, and then it puts that forward to the creditors using the insolvency practitioner to reach a binding agreement. The advantage with the CVA is that if you've got someone that doesn't agree, provided you've got the necessary 3/4 of the people that do, then actually it binds everyone in. So that dissenting creditor can't actually get rid of the plan and veto the plan because of everybody else. And CVAs can be used to re-gear leases. You may well have seen in the media CVAs used at varying levels of success. Debenhams, which obviously didn't end up too well. You've had Prezzo's, New Look. There's been a number of these large companies that have used CVAs to re-gear their leases. But that's based on large companies with large amounts of properties where the landlords are really concerned about losing that customer, losing that tenant. So with a smaller company, they may not have the same amount of clout with their landlord that their landlord's going to say, yes, we're happy with this. If they're not too concerned about losing the tenant, are they going to be agreeing to a CVA that significantly reduces the rent that they receive when there is potential that they could rent elsewhere? And there is some concern now. You may be aware that HMRC's status in an insolvency has changed. So for many years, they've sat with all the other creditors. They've sat with the unsecured creditors, the trade, redundancy and things like that. But this changed at the end of last year. So they now sit preferentially, so just below the employees for their arrears of pay and holiday pay. So if a company's looking to do a CVA and it's to manage unsecured creditors, the first thing they're going to have to do is pay HMRC in full, because they automatically rank higher. So is that going to be possible for companies? Well, if they've got the deferred VAT, they've potentially got PAYE, they've not paid across on those furlough payments, it's going to be difficult. If they're owed money, the CVA option, unfortunately, might not actually work. So we move on to the more formal insolvencies, as people may see them, what people see more as a potential sort of failure and regrowth of a new company. So we're looking at potentially administration or liquidation. So for both of these, directors often ask whether they can be directors in a new company going forward. And they absolutely can. There's no automatic disqualification. Just because a director's been involved with a failed company, that doesn't mean they shouldn't be involved with a new company going forward. But it can happen in some cases. So in some cases where the directors have acted inappropriately, the Insolvency Service may actually take a view that these people shouldn't be directors of companies going forward, and therefore actually disqualify them from being directors. But what we're looking at here is, you know, your rogue traders, your people that directors who are doing things that they really shouldn't be doing. So they're taking deposits from members of the public, knowing full well they're never going to supply the goods or services. And that's not a case of they took deposits and then COVID hit and they weren't able to supply. This is knowing that they're taking these deposits, really knowing that they're not going to be able to supply the end service. And then you're looking at things where, for example, the director owes his brother some money and decides to pay the brother before he pays everybody else, and therefore ends up winding up the company with the unconnected creditors paid, with the connected ones working away quite happily. And then you're looking at sort of other things such as not paying any amounts to HMRC for a considerable amount of time, so 12 months plus of non-payment to HMRC, without having engaged with them, without having to try to reach a payment plan or anything else. So as you can see, the disqualification could happen in administration or liquidation, but that's where they're doing things they shouldn't be doing. So the main thing is to act properly. And here it's about getting proper advice. So making sure that as directors, they're protecting themselves, they're doing what's right for the company, they're doing what's right for the creditors, and they're doing what's right for themselves. And that only comes about through taking proper advice. And the other thing that's obviously the concern is, can the directors buy back the assets? This only works where there's an underlying business that's viable. If the underlying business isn't viable, then there is no point in setting up a new company, transferring the business from the old company to the new, and then the new company failing, because all it's done is cost the directors and the creditors a lot of money. So provided there's an underlying viable business, then absolutely the directors can buy back the assets. They need to make the best offer. And where we're talking about small businesses, it's more than likely that directors are the ones that are going to make the best offer. There's not going to be a huge amount of other interest out there because of the nature of these businesses. But also, quite often with these businesses, it's actually the director that's the key contact. Their customers have a relationship with the director, who then has his company. But the relationship really is a personal one. It's one between the director and those creditors, and those customers. So actually, they're most likely to be the ones who are able to take the business forward. But the finance of this needs to be considered, because not only does a director need the finance available to buy the assets, they also need the finance available to be able to get the company up and running. So they need the working capital. They need to be able to get everything in line so that they can then get up and trading before they actually see any money coming in. So this is where maybe an asset-based lender might be useful, or alternatively, perhaps some invoice discounting to get some initial money in to help out with that working capital. And the working capital and the cash flow, that's going to be key. And again, I know I keep saying it, but producing these cash flow forecasts, working with accountants, bookkeepers, this is where the directors really make sure that what they're doing is right. Unfortunately, with new legislation in place, for the directors to buy back businesses is actually really difficult in administration. I won't go into detail, but I'm more than happy to answer any questions if you wanted to ask after this about the recent legislation changes. But in reality, with the changes that have been made recently, selling a business back to a connected party in administration is actually a lot more difficult than it used to be. And for those small businesses, it probably actually means that administration isn't a viable option if that's what we're looking to achieve from a sale of the business. So it's actually much more likely now that the business would be sold through a liquidation process. So we come down to the final option, which is probably quite an ironic term to use because the directors do see this as a final option. No director enters into business thinking, I'm going to enter into this and at the end of it, I'll put my company into liquidation. No one wants to see their company enter into liquidation. No one wants to see that be the end. But actually, liquidation can be a really viable tool. It can be used to buy back the business. It can be used to take a business that has underlying viability, but has been affected due to, in this case, potentially COVID, and actually move it into a new vehicle that means it can trade successfully going forward. Those creditors that have lost money in the old company will actually have a new customer going forward. So in this case, can the director use the company name? Well, there are restrictions, but it is possible. So again, without going into the technical background, there are restrictions on using the same or a similar name. So if someone sets up as Robert Smith Marketing Limited and then decides to change it to Robert Smith Marketing 2021 Limited, that implies that there's association between those two companies. So there is a restriction on directors doing this, but the restrictions do have options that you can actually overcome these. So the business could be bought back from the liquidator, or directors can apply to court to get leave in order to be able to reuse the name. But the timing on both is key. So for directors, they need to make sure that they've either bought back the business or they've applied to court before they start trading. And the reason why this is really key is that if they get it wrong and the new company were to fail and they haven't gone through the steps they needed to, then actually they could find themselves personally liable for the debts of the new company. So it's really important to get proper advice and to make sure that what they're doing is right, so that then the new company is set up in the right way and the directors are avoiding any kind of personal liability going forward. So in all the cases we've looked at, whether it be CVA, administration, liquidation, or even an informal arrangement, I've talked about what directors should be doing, but it's really important to look at what they shouldn't be doing. So generally making the position worse. So just continuing to trade, knowing that there's no chance of turning this around, incurring more debt. Directors could actually find themselves personally liable for the debts of the company, which obviously they need to avoid. So incurring more debt, knowing full well it's not going to be paid, just needs to be avoided. And again, I go back to, yes, again, the cash flows, producing cash flows, showing that actually they're continuing to trade for a purpose. They're continuing to trade because of the fact that actually here's how they're going to get out of it. Alternatively, if the cash flow shows that all they're going to do is to make the position worse, that's the time to say, I now need to take advice. I now need to look at one of these other options. And really, really key is going back to the not over-promising and under-delivering. So making sure that if directors are entering into negotiations with creditors, then those negotiations are sensible. What they agree actually works, because otherwise they'll find themselves having to go back a second time. The second time you go back, the creditors are going to be much less sympathetic. And if directors are going to borrow, looking at, you know, personal guarantees, is that the right thing to do? Is it right to be borrowing money with personal guarantees in an old company, or actually it might be more sensible to do that through a new company so that the money is going into something that will be viable moving forward, rather than potentially just going into a leaky bucket? And I think hopefully I've made it quite clear that in all cases, it's about getting proper advice. It's about working for these directors with accountants, with bookkeepers, getting their cash flows right, and then getting the proper advice to make sure that what they're doing is in the interests of themselves and in the interest of their creditors, so that everyone can come away from what's happened with the best outcome possible. So I appreciate that was a bit of a whistle-stop tour. As I said, more than happy to answer any sort of lengthy questions afterwards, feel free to give me a call, drop me an email if there's anything that you want sort of more detail on. But what we'll do is we'll spend a bit of time answering any questions that we've got in the chat, anything that we can answer quickly, and then we can always come back to you if you've got anything that's a bit more, there's more in it, you know, if you need a bit more of a lengthy answer. So we'll move on to questions. So thanks very much. So had a few questions here, a couple of them about the, just reading them here, about the price and payment terms, and also about clients getting advice. So one of the questions I've had is about who sets the price if the director wants to buy back the assets. So with a liquidation administration, it's important that the assets are valued. So we would arrange for a valuer to do either a desktop valuation if we're looking at something quite simple, or alternatively attend site and do a full valuation. The reason being is what we need to know is how much could we get for these assets on an open market. In reality, the assets are worth what someone's going to pay for them. So if we've got a director that wants to buy all of the assets, they're far more likely to be paying more than someone that's going to come along and buy a couple of office chairs and a table. So it's based on the valuation, but equally it's ensuring that what we get is what somebody's willing to pay. So if the director is willing to pay more than anyone else, then that's a price that's set. And that leads on someone asking about whether the assets can be purchased on deferred terms. Again, it comes down to value of the assets. So if we're looking at sort of a relatively small transaction, then we'd be looking at quite short deferred terms. A larger transaction, larger deferred terms. But again, it comes down to, is it the best offer that's available? So if the best offer out there is from the director buying the assets on deferred terms, then absolutely that's something that we would look at. Next one, and I can well understand why this has been asked, is how much does it cost my client to come and see you? The answer is the first meeting is always free. We never want you to send a client to us who is in financial difficulty to find they get a bill at the end of it. That is not what we're here to do. We're here to help. So we would have the initial meeting, there'd be no charge for that. And quite often, actually, we have a number of follow-up calls where we're dealing with queries. The point at which we would start charging is if we're actually instructed. So if the company enters into administration, liquidation, our fees are agreed by the creditors. Alternatively, if it goes beyond just a bit of informal advice. So we're looking at something a bit more formal, maybe helping get creditors into a debt management plan or something like that. We'd agree the price with the client, and again, quite often we'd actually agree to deferred terms, so that can be paid over time. Got time just for one or two. So there's a question here about leases and the terms possibly being extended. So for those companies that have taken out a lease, a payment, a rent holiday, so they haven't paid any rent for possibly 6 months or so, that rent will have to be made up. So it could well be that when it comes to the end of the what would have been the normal rental period, that an additional 6 months is actually added on in order to make the payments for the rent that wasn't paid for that period. That would be a negotiation with the landlord to agree in terms of how is that deferred rent to be paid. Just conscious that we are moving on in time, so I will bring it to a close now, but just want to take the opportunity to thank you all for joining. I hope you found that useful. We'll be doing another one of these I think in June or July. We'll send out all the details to you, but any questions you've got, please feel free, drop any of us an email, give us a call, and we're more than happy to help. So thanks again for joining.